Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Chatter this week centered around the economics of pandemonium. Admittedly, I don't recall that chapter in any of my economics textbooks. In any event, this week, our three things are: 1. Wealth effect. It's real, and it's been a big part of the consumer's willingness to spend. Now it's falling. 2. The default cycle. We'll dimension what this upcoming one looks like. And 3. Volatility and financial stability. We'll have a look at this week's events. Let's dig a bit deeper. Falling wealth effect. When we think about economic growth, we always start with the health and willingness to spend of the U.S. consumer. And the consumer's relative strength as we head into an economic downturn is an important consideration in our belief that any recession will be relatively shallow. The consumer benefited substantially from pandemic relief programs, both directly from enhanced transfer payments and indirectly from fiscal support and monetary accommodation that boosted individual stock portfolios and housing values and enabled employers to quickly bring back laid-off workers. The end result was a remarkable $34 trillion surge, or 29%, in household net worth from year-end 2019 to year-end 2021, according to the Federal Reserve. But we all know what's happened to the consumer's largest asset, their stock portfolio, in 2022. Since year-end, we estimate stock market losses have accounted overwhelmingly for the $13 trillion, or 9%, fall in consumer net worth. And now we are just starting to see softness in consumers' second largest asset, residential real estate, which was down 0.6% in July from the June level, according to the FHFA National Home Price Index. And by the way, that is the first negative print since May of 2020. Now, we also believe excess savings, estimated to be $2.5 trillion at year end, is also running down, especially in lower income cohorts. The point is, when you add it all up, a big drop in equities coupled with cracks in the residential housing market means Americans do not feel quite as flush as they did at year end. The absolute downdraft doesn't feel all that material, 9%, which really can be, or should be, viewed as folks giving back just a bit of what had been outsized gains. But sentiment is a function not only of a logical response, but an emotional one. So while the logical part suggests Americans continue to have plenty of spending capability, the emotional part will weigh on consumer sentiment and their willingness to spend as we head into the downturn. All right, let's move on to our second thing, the default cycle. High-yield defaults in a recession can reach double digits. In fact, it has averaged around 12% for the previous three recessions, excluding COVID's sharp and short one back in 2020. Through the pandemic period, of course, defaults dropped to negligible levels, courtesy of the Federal Reserve and Congress, which provided unprecedented support to the economy and credit markets. So how should we think about the default cycle that's now in front of us? Well, to start, we need to dimension the downturn. We believe it'll be relatively shallow for a couple of reasons. One, consumers, businesses, and the financial system, for the most part, are all in good shape. All three have improved their respective balance sheets through the pandemic period. Consumers are sitting on savings that are roughly 50% higher than pre-pandemic levels, and their net worth, notwithstanding the aforementioned hit from the downdraft in the equity markets, is 24% higher than it was coming into the pandemic. The consumer is also comforted by a strong jobs market, so they have the ability to spend. On the corporate side, margins are at 50-year highs, and many firms used unusually favorable credit markets over the past 2 years to pay down and/or refinance debt to keep debt burden at a reasonable level. That said, investors should be aware that zombies, those established firms whose cash flows are insufficient to service debt, will face the force of creative destruction that has been kept at bay by those same unusually accommodative credit markets that are now becoming far more discerning. And the financial system, where problems can turn a garden variety downturn into a full-blown crisis, is sound with increasingly diffused risks, very low levels of problem assets, and far better lines of defense than has been the case in the past. So overall, we are coming into this downturn well positioned to withstand the continued contraction in economic activity. Now, our second point to note is that market forces have already washed out vulnerable sectors over the past 5 years. Think poorly positioned retailers and energy producers. And COVID washed out additional firms in its short and sharp recession back in 2020. So if you've made it to this point, chances are you've learned how to survive. And that argues for a more benign cycle this go-around. We also would make note of the government's evolution with regard to how it responds to downturns. The incentives in democracies is to preserve firms because they employ people, and voters don't support regimes with high unemployment. Moreover, recent crises have been instructive to governments about what to do, stimulate and accommodate, and what not to do, impose austerity. Today, central banks and governments are, to quote a Wall Street Journal editorial out this week, easily spooked into rescue mode. Now, that intervention argues for fewer defaults and more zombies. And it's fashionable to think that we were entering a less accommodative era in the wake of the pandemic period excess, but if Truss's unfunded tax cut and Biden's student loan forgiveness plans are any indication, government giveaways have not gone out of style. And all of this, the strong starting point heading into the downturn, recent washouts of vulnerable sectors, and the enduring popularity of direct government support figures to reduce defaults in this cycle below historic average. All right, on to our third thing, volatility and financial stability. This was the week when we heard financial stability creep into the market's discussion. My reference at the outset to the economics of pandemonium comes from chatter this week in response to what we bore witness to. Until now, the correlation from the pandemic and all of its easy money excesses did not raise concerns over financial stability, which is one of the great dividing lines between a simple turn in the economic cycle and a crisis. It's the difference in the U.S. between corporate earnings falling 10 to 20% or 40%. It's the difference between 1 to 2 years of downturn duration and 5 years or more. Financial instability is not a welcome development. Now, reflecting on this week's events, we would make the following observations. 1, fiscal and monetary policy are now at odds. These two blunt policy instruments were coordinated in response during the pandemic. Now, governments are stepping up to provide relief these days for both targeted reasons, such as relief from the energy spike, and untargeted reasons. Central banks, on the other hand, are tightening financial conditions in order to curb inflation. Tension between the two have led to market confusion as a result. 2, market shocks and leverage do not mix. And we often come back to Warren Buffett's adage that you discover who's swimming naked when the tide goes out. Runs in markets happen when you mix leverage and asset liability mismatches. And as long as governments solve crises with more debt, financial stability will come into question in downturns. 3, markets ride an escalator on the way up and an elevator on the way down. Cute, right? Well, an old chestnut from the annals of finance is a reminder that forced selling and or de-risking pours gasoline on a market fire. And 4, dollar strength of this magnitude is a cautionary indicator. The dollar spot index, the DXY, has reached its current level, 113, just 2 other times in the past 50 years, during the WorldCom Enron-driven recession in 2000-2001, and in the wake of Paul Volcker's unprecedented rate hikes in the early 1980s. It's not good for financial stability. At the end of the day, we would not be surprised to see one-off market dislocations arise as Warren Buffett's tide is clearly going out. But what we really worry about, contagion, does not seem to be in the mix today. And that keeps us in the shallow downturn camp. So there you have it. 3 things in credit. 1, falling wealth effect, expected to lean on consumer spending. 2, the default cycle. We do not expect default rates in this cycle to be as high as it has been in the past. And 3, volatility and financial stability. Expect one-off market dislocations in this environment, but the risk of contagion we see as less likely. As always, thanks for joining us. Don't forget to check in on kbra.com for our latest research and ratings reports, including a new piece from yours truly titled, Credit Finds Itself in a Riskier Place. See you next week.